Thanks so much to my co-host, Matt Druin, for covering for me for the last 2 weeks while I was in the Bahamas. We've got the pleasure of having Melody Wright on the show. I've been following her for quite a while. I love her podcast, and I love when she comes on as a guest. So I'm really excited to have her on today. And without any further ado, let's bring her on the channel. Hey, Melody, how are you?
I'm doing well, guys. How are you doing?
Excellent. It's finally warming up here in Rochester. Spring has sprung.
It's same here in Tennessee.
Nice. We usually just kick off the show by having you give a little bit of background on, your history in real estate and kind of bring us up to where you are today.
Sure. So I fell into mortgage in 2006 by accident, which is how everybody who's in mortgage gets into mortgage. Nobody kind of grows up wanting to be in mortgage, the word that means death pledge. So I kind of, I started off in academia and realized that was never going to pay my loans off. And so I needed a real job. So basically I went off and kind of got a project management job in a mortgage company. And, it was October 2006, and I heard, I felt like I was in Enron, essentially. There was a party, they'd made a ton of money the year before. They were the crown jewel of GM's portfolio at the time. And I kind of looked around and was like, this does remind me of Enron. Just the way people were acting, the mania. And, fast forward only a few weeks forward, they had just recently been purchased by Cerberus, which is private equity. And I became kind of their girl Friday, going out across this very large organization, even though I was brand new, figuring out they needed to know, how does the mortgage business run? And so I kind of went across the organization, gathering management reports, talking to people, providing them information. And so I got a crash course in how all of this works. At the time I was in corporate finance. And so you guys know what happened after that. And that we were early. We led the write downs. It was, total mayhem. 2009, we didn't go home. We were in the office 185 days straight. My company was number one on the bankruptcy watch list for almost 5 years until we finally did, kind of file bankruptcy. And so I kind of transitioned from corporate finance, where I used to write the messaging for earnings release and things like that. So I remember very well how everybody was getting it really wrong back then. And then I went on to kind of to help with the consent orders and the AG settlement, when the servicers got into trouble for robo-signing. And then I helped with our bankruptcy. And then finally, part of the bankruptcy was, in order to do a successful auction, we had to make sure that we were increasing our pull-through rate on foreclosures. Our Fannie or Freddie would pull our servicing. So, people think of the government often being in and as the good guy, and actually they were pushing us to move these foreclosures. And so after that, I went and managed default. And similar to, I kind of did a boots on the ground, went all over the country, looking at the different states' laws, like, what the issues were, so that we could figure out successful exits for these borrowers. So that's a lot of history on that. But once kind of we filed bankruptcy and the new owners took charge, I went out to several other non-bank originators and servicers, really trying to help them understand what the new regulations meant, what, the AG settlement meant for this world, what Dodd-Frank meant. To not great success, I have to be honest. And then from there, kind of one thing I realized was really broken was technology in mortgage, because essentially the systems they use are from 1968, 1972. They're that old. They don't even have the code. They don't know how to fix the code anymore. And so I did a lot of wraparound solutions for them, and even worked on core solutions. But unfortunately, even when you had a better option, there's such a monopoly of the technology in mortgage that it really didn't matter. But essentially, while I was at one of those FinTech companies, we had this, COVID happens. We have this origination boom that is just absolutely bananas. And my leaders kind of turned to me and said, "Hey, I need you to tell me when rates are going to rise." And so I kind of just dove in to macro. I've spent the last 3 years just really studying macro. And I kind of realized that I felt people were getting it wrong about the inventory story. It just wasn't lining up with my experience, what I had seen, demographics. And so I kind of went out on the road, just got in my car, went out on the road, and went kind of traveling across the country to different cities, and realized from that boots on the ground that there's so much inventory out there that we don't even realize. And, there's a lot of reasons for that. We can get into it or not. But that's kind of how I got my start. And then I started writing my Substack, and doing my YouTube pretty much this time last year. So this is like, I'm coming around to a year. And sorry, that was a really long intro, but
no, that wasn't long at all. That was perfect. Matt, you want to kick it off?
Yeah, absolutely. Well, thanks for coming on the show, Melody. My name is Matt. So I was like, the story you're telling sounds like you're dealing with a lot of problems and a high volume of problems through all of this turmoil. And I heard words like mayhem and chaos. From just a psychological standpoint, like a lot of people would be dealing with burnout going through that. Like, can you kind of walk me through what you were feeling psychologically through this? Because I mean, people didn't know which way was up during that time, and kind of like how it was formative to what like you do now, if at all. Maybe you're like a complete peace, tranquil person now. So
no. That is such a great question. No one has ever asked me that, and I've probably wanted to talk about it a lot. During the time, so a lot of people talk about the GFC and they talk about 2008. When you were in the industry, like that, it was 2007 to 2015. Honestly, that was your GFC. And even in 2015, you were kind of coming out of it. So I think during that time, I was just on autopilot. I mean, I actually remember walking into GMAC headquarters. Like I would have the one day of the weekend maybe off, and I'd walk in on Monday having not spoken to another human like that prior day, and feeling like I just turned on like a robot the minute I kind of went through the doors, because you were you were a machine. Like all that traveling I did, I would go out on the road. My team would go with me for 3 days. That team would leave. I'd be, all the way across the country. Another team would join me. It was just autopilot. But it was so crazy. You also felt like you were saving the world. I mean, I know that sounds weird to people, but we were trying to save jobs, and we did. We saved a lot of jobs. We were meeting with the other big four servicers. We were meeting with the Fed every day. I mean, it was so insane. There's really no way to describe it. And I think, I didn't really start processing everything that happened until 2015. And I took 4 years away from sort of real leadership roles, a lot of things, just kind of trying to process what we had all been through. And I think that's honestly what happened, is people either never had time to process it, or they left the industry. And I think that honestly, some of what we're dealing with is because people, they either just burned out, like you said, and walked away, or they still haven't processed it, to be honest. So I hope that answers it.
Yeah, not dealing with like their trauma.
And it is trauma. I mean, I know we overuse that word these days, but it really was no sleep, no rest, no taking care of yourself, just total putting your life on. It felt like your life on the line every day. And I wasn't in combat, I was just working in finance and mortgage, but it felt very similar to combat.
Yeah, 100%. There's a thread that I want to pull on before I give a question to Mark. And it is, you talked about inventory and that there wasn't or isn't an inventory problem. Can you tell me more about that?
We have an inventory perception problem. And so, I cannot emphasize how much vacancy is out there. It is just so staggering. And so I think what people, everybody kind of looked and said, well, everybody stopped building, and so there's this big, hold on. What happened is the institutional investors came in, they bought up all the existing inventory at auctions. I was there. I remember it, and Fannie and Freddie were pushing it. And so you had a lot of inventory come off market and for long-term rental. And so, and then you kind of look at the demographic picture and you realize we're not having babies like we used to have. And then you kind of look at all the, almost 15 million vacant homes. We have our second homes out there. And then you kind of, one thing that was happening, and this really got started back, the seeds were planted when all those institutionals came and bought up all those foreclosed properties, is, the fix and flip, right? Everybody went out and all those shows, they started building and fixing and flipping. And so then the short-term rental craze, right? You don't need 15,000 short-term rentals in Austin, Texas. You just don't, And so everybody was thinking, okay, let me get my side hustle, right? This economy, even though people are saying it's awesome and jobs are everywhere, the jobs are gig or they're part-time or they're not full-time jobs that are going to make me a lot of money. So everybody's like, how can I make sure I do okay? And I think everybody kind of wanted to get into this passive investing. And then COVID comes along and just that goes on steroids. And suddenly you have private builders, not nationals, private builders who are working just with brokers, like building homes, selling them on Facebook in a couple hours, just insanity. And then you have an industry that just wants to refuse to acknowledge that that's happening, that they're being, that NAR is being pushed out to some degree, that, finally the internet is, taking our social media is playing a part in all of this. So, and really the demographics too was just a big, big part of it for me. And the fact that, boomers are retiring at $10,000, at 10,000 people a day, not dollars. And those second homes were becoming more and more and more expensive with increasing, property taxes and insurance. And so you just knew those homes were going to come back onto the market. You also knew short-term rental was oversaturated. And then you had all the build for rent. And so you knew that single family rental was oversight. And then don't get me started on multifamily, the highest building since the 70s. And we don't have the demographics to support it, even with immigration. And so, and then I just looked at all this and said, no one is saying this. Not really. There were a couple of people that were kind of saying it. And that's when I got on the road and I saw it for myself and realized that the builders aren't listing everything on the listing sites. They're not listing them on the listing sites. And so there's, probably a good 25 to 40% more inventory out there than most people think there is. And so that but it's very, you hear it every single day and our politicians talk about it every single day. Now, is it priced affordably? Absolutely not. And so it's kind of misaligned, like it's mispriced. And so therefore, if you are a young family trying to find a home, it's impossible. You're going to think there's no inventory. In reality, that inventory has been sitting on the sidelines because they weren't making the cash flow that they wanted. And it's starting to come. People are starting to get to the point of distress that a lot of investor properties are being listed now. And we're seeing that especially in Florida.
Yeah. We're starting to see that here in Rochester as well.
Really?
We manage, about 450 units, and I've had a lot of calls from investors that are saying, hey, my rate's going to reset. I want to sell before the reset because I'm really not going to do well when the rate resets. I've listed more investment properties this year, probably by 5x than any year in the past.
Wow.
And the calls keep coming in. I got another call yesterday where an investor wants to start to unwind. But from what you just said, there's so many different threads to pull on. I don't even know where to start.
I'm sorry.
No, it's okay.
I should have been taking notes.
Yes, I should have been taking notes too.
Well, I think that's a lot of people struggle because they want it to be one thing, right? And it's actually a ton of things at once, all coming from different directions to the same station. But go ahead.
Yeah. So maybe the shadow inventory part, because I know I do foreclosures. I've done foreclosures for years. And when we went into COVID, they put a moratorium on foreclosures and we didn't have anything go through what seemed to be probably like over 2 years. I don't know exactly how long, but it was a long time. So we've got all that shadow inventory from COVID that's still now just starting to work its way through the system, let alone anybody else that went into default during COVID. Like, where are those houses? So I definitely see what you're saying about the shadow inventory. But here in Rochester, everybody has the opposite view. Like, there's no inventory and we'll have a dozen, 2 dozen offers on properties, even in the commercial space. We're 5 years ago, you might have one buyer, he would negotiate the multifamily with the seller. And now it's like, the broker sends me a large multifamily, and if I don't have an offer to him in a couple of days, he's like, "Oh, sorry, it's under contract. Just wait for the next one." I'm like, what is going on?
Right. It's wild. And, I looked at Rochester because I track it right before I got on and saw that, really year over year inventory is flat.
Mhm.
And so it looks like you guys have kind of been treading very much the same since I started tracking anyway. And, but your median home price is very different than all over the country.
Yeah. It's because our taxes are higher. So I tell everybody the payment ends up being the same. If you're to live in a different state, your payment with the lower taxes and the higher cost of acquisition, you have the same payment. So it's really, New York is kind of like stripping our equity by having our taxes so high. If our taxes were lower, our home values would be a lot higher, and we'd be wealthier.
Mm-hmm.
Yeah.
So Melody, one of the things I was talking to Mark in the green room before you came on was, in terms of capital markets, I guess we're going to talk about some macro stuff here. In terms of capital markets with residential mortgages and commercial mortgage capital markets, it seems in my lived experience over the past, let's say 12 months, there's sort of been a divergence between those two, when they, before we started having things going wacky, that they were kind of going in lockstep with each other. Can you kind of talk to me in terms of your opinion on maybe how those two worlds are functioning right now, and what you've seen trend wise, in terms of, has there been a divergence of those two markets? Has there been a convergence, and that type of thing?
Well, crazily, we just saw that CMBS had a pretty good quarter, commercial mortgage-backed security, and an increase. And I'm just like, what is happening? I mean, there's so much, and the biggest increase was in multifamily. It was like 19%. In terms of the divergence, I'm not sure, but I just think that right now what's happening is that we're on a wave of narrative. And of course, for mortgage-backed securities, residential, Powell's not buying the MBS anymore. And that makes a huge difference, as well as, you really, so we've got a lot of nonsense going on right now around Basel III capital requirements and the way that these assets are weighted at the banks. And so everyone needs the banks to buy this MBS. And so I think that's why that, Powell is actually backing down on the capital requirements piece. But I think until you have somebody who goes, very actively buying MBS, not today. So that would have to be someone like the Fed, or, that honestly, this is going to be a very tepid market. And I think that you're also seeing right now, for instance, mortgage servicing rights are very hot out there, but that's about to wane too, because so many people are needing to sell their servicing rights because they're cash poor, these mortgage non-banks. And so I honestly believe that both markets, so MBS is just kind of, in my opinion, trucking along. It's not good. It's just not good. And then commercial mortgage-backed securities, I just think that they're still delusional. I mean, I think that when the Fed so-called pivoted in December, developers got like, oh, it's going to be okay, extend and pretend, I can stay alive till 25. Let's go ahead. Let's start that project. And I think that's what you're seeing is the narrative in the commercial mortgage-backed world. So, I think there's two very different drivers. So hope that helps.
So delusional in what way on the CMBS side of things?
I cannot. So it's one thing to read these stories. It's one thing to read about St. Louis, which was just in the Wall Street Journal earlier this week, or I think yesterday, and the doom loop there. But once you get to these cities and you just see the overabundance of vacancy, as well as kind of new construction, there is just so little acceptance of what's out there and what's going to have to happen. And it's not just work from home. It's actually, we were overbuilding. You take Dallas, for example, they have two big, huge commercial office buildings in progress right now. And they already have some of the highest, vacancy rates. And so there's going to have to be bulldozing, and then the multifamily. I mean, I've seen Evergrande style buildings completely empty on the road. I mean, just huge multifamily projects. And so it's as if everybody just stopped talking to each other. They stopped driving around looking, and they're just all in their own sort of, channel, and they're not paying attention. And so people should be talking right now, in my opinion, about what are we going to do about this? How are we going, if I was in a city, and I am here, we don't have a lot of commercial real estate where I am. But like when I was in New York recently and saw, I mean, that city is completely empty now. It's crazy. Like, let's get together. Let's talk about how are we going to save the city? Like, and what are we going to do with these buildings? And we know that converting them to housing is not an option. And so that's kind of what I mean. Is that if you're a developer in this space, there's got to be only one or two places left that make any sense from a commercial real estate perspective, in my opinion.
Yeah. Maybe we should pivot gears. I'd love talking about the short-term rentals because I'm on your train, but I've got a lot of colleagues that just embrace short-term and they're, full force short-term rentals. But I feel like it's just way, way oversaturated, and any kind of hiccup in the economy could really spell disaster. And what does that look like for inventory? And compile that with, some of these larger institutions. Are they going to start unwinding also if there's any kind of hiccup in the economy?
Yeah, and it's already happening. It's like you can look into Florida and you can see, short-term rental is such a huge percentage of the things that are coming to market. And the distress is real. I mean, I know, I've worked with short-term rental lenders, and honestly, I think there's some good actors out there, but then also you have to realize they were relying on really deficient tools. I know lenders that were using very well-known applications out there to try to do, revenue projections, and they relied on those to lend out. Then you deep dive into these companies and you realize they do crazy things like a 10-mile radius for comps. Like what? I mean, that's insanity. I mean, when you're in the short-term rental, and unfortunately, so many people didn't do their due diligence. You had kind of like this multi-level marketing scheme where somebody would say, "Hey, I've got this hot property for you," and they give you a brochure and they say, "You're in Kyle, Texas, right outside of Austin. There's this great bowling alley. There's a great school." Okay, go 22 miles south of Austin to Kyle, Texas, and look for yourself. Because nobody's coming out there and paying $600 a day for a short-term rental. And I actually, in one of these very well-known applications, that is a true example. I looked up that property and it said $600 a day. They never got anything like that in Kyle, Texas for a short-term rental. And so, unfortunately, there's just so many bad assumptions out there and so many people didn't do their due diligence. I mean, this is going to be, it's just started. I know people with 10 properties. They've just sold the first one and they're having to and they've already spent all that equity. That's the other thing people don't understand. Like sure, you think they had it. No, they just spent it going to get another property. And then, it's all run out. So, I think we haven't even begun to really see, except for maybe in Florida, the wave of these short-term rentals. And Vegas, places like this, it's going to be very impactful.
Yeah.
So on the, is there a reason why you can't name the application? Because I know which one it is. Can I say?
You can. I just won't.
All right. So this may be a different application, but I was networking with another investor who's focused on the short-term rental space, and they were picking my brain about converting their hard money loan into a permanent financing with some of these non-bank entities. So he's like, "Can you look at this term sheet that they sent me and let me know if you have any questions or anything I should pull out of it?" And it said, one of the qualifying things there was must meet something with the AirDNA rate for this this whatever market. I was like, how is that even calculated? And
Right.
I've used AirDNA before, and it spits out the same sort of like nonsense type of things. And I've even seen some of these non-bank mortgage lenders use like, there's no appraisal needed. We use the Zillow and Trulia estimate of the home value, or Realtor.com estimate of the home value. I'm like, where is the freaking due diligence that's happening on this? And it's like, DSCR loans. I've been in real estate for 18 years. Okay.
Wow.
My second property was with and this was back in 2008. My second property was a DSCR loan. It's called a portfolio loan. This typically done with community banks. And now there's this trend, and everything was like, just get a DSCR loan, just like we had with when I was in real estate, and there was they didn't call it subprime mortgages, they called them non-conforming,
non-traditional products. That's right.
Mm-hmm. So I'm seeing a lot of that in that space, and we're seeing like a lot like, okay, well, STR, short-term rentals aren't working. So, let's there's all these traveling nurses, the traveling nurse narrative, right? That it's like, they're all over the place. There's hundreds of thousands of them that can't, that don't have housing and that sort of thing. So now these STRs are getting converted to MTRs because the STR people that made a bad business decision, they're like, well, I have all this furniture in here, so I don't want to like move it out to go to an LTR, and I can't go to an LTR because I overpaid for the property. I didn't run my numbers right because I based it on this business model. And it's like, how much cash burn can these investors face going forward until they have to capitulate and sell and possibly even do short sales? But I'm just seeing so many people do these non-bank DSCR loans. And what I'm curious about, Melody, is the DSCR loans. Where is the capital coming from to actually fund those? Is it at the hedge fund institutional investor level that has partnered with these non-bank entities, or tell me about that?
I think it might be some sovereign wealth funds, to be honest. Like, I've had so many of them contact me, and I think you've got like oil money. You've got money that is that's always going to be okay. Put it that way, or at least in the, for the foreseeable future. And you just had so many people out there, wanting this passive income. You've got these small moms and pops doing these private note sales as well, but I do think that the all cash money is largely a combination of sovereign wealth funds, I think, as well as wealth management groups at places like PNC saying, hey, we know it's competitive out there. You're a high net worth individual. Let me give you a free $1 million of cash. And so I think I'm very curious about bank earnings tomorrow. I think Goldman has given us a real preview of this through their consumer, division that didn't go so well. But where I think that, these people got very overextended. And so we're looking at provision for loan loss on loans, for mortgages. But in reality, where we should be looking at is where are the losses in those wealth management groups, these other types of loans. And I think that they're hiding a lot of this stuff. Just, whenever you look at Chase's balance sheet and 10QK, like it is very complex, right? And so I think that they're able to hide a lot of the distress, especially the bigger banks. But I do believe it's starting to bleed through. We're starting to see, actually a provision for loan loss and allowances build.
Okay, quick question from Corbin Luta is, we want to get on like the LinkedIn Live thing here. So Corbin Luta has a question, Melody. It is, what is a sovereign wealth fund?
So think of it as like, government entities, so that want to make investments. Like we know, for instance, Switzerland, they own a lot of Apple. But if you think like these, it's backed by someone, say like the Saudi government, and whether it's private money, government money, these things get very gray. But I do believe that there's quite a bit of money out there from other governments, just knowing that the US is, real estate is 85% of global wealth. Like in real estate in the United States is typically a good place to park, especially when things are going wrong globally, which we're seeing now, many countries struggling. So this has been a safe place. But one thing that I've been theorizing with the increased sales in California that are just kind of outpacing some of the other states is I believe that some of these folks might be starting to unload, actually. That they see this as the right time and they're starting to get out. And that's why we're seeing some of this higher dollar properties move in places in California that have a lot of that foreign investment.
So based on your recent visits to these different US housing markets, what are some of your predictions for residential and multifamily in 2024?
So 2024, which is we all know is an election year, I honestly believe that we're going to skate along here. Narrative is going to continue to be, the driving force. The stock market kind of mania. If that persists, that's going to make people feel wealthier than they are. And I think you're going to have those that have transacting. So your top 10%, because I think actually that top 20, they've started to kind of be like, I can't handle this. This is just too much money. This doesn't make sense. But your top 10% will still transact. And then of course you have death, divorce, default, and the DOD. So you're going to have those transactions. But honestly, my forecast right now is that we will end the year down in home prices, probably around about a 5% mark. And of course, with something like Case-Shiller, we won't even know that for, 18 more months. But, because it's so delayed. But I think that 2025 is when distress is going to be realized. I think that's when your prime borrowers, we're already seeing them come under stress. There was a little catch up in the tax and bonus season. But like my mortgage books that I oversee for clients, highest delinquency in March that we've seen in 2 years. And that seasonal catch up lasted for a month. And so we are definitely, the consumers come under stress. And I think by the time we hit June of 2025, the prime borrower is going to be under severe distress. The ones that were, a little bit stretched. And then of course, if we have job losses, meaningful job losses, or a credit event, that timeline could expedite.
There's a follow-up question on like when you're looking at the macro, do you do any kind of delineation between like major metro areas and then more urban, quiet, sleepy towns? Because I know prices aren't uniform when you go from a metro where things can get really heated and get really out of line, like Phoenix or Austin. And then you could look at something like maybe a Rochester or even a smaller town like where I'm from, Williamsport, Pennsylvania, population 40,000. Do you do any kind of analysis that separates those two to kind of see if problems are really just occurring in these larger metros, or do you just always use averages?
Yeah. So why I think I'm a little unique is that, I started tracking cities. I refused to track just MSAs. I did not feel like that would give me enough information. I'm up to 80 cities that are a combination of tiny little towns and big metros. And believe it or not, I pull the information myself every week. I look into these places every single week to see what's going on. And so I've spent a year gathering that data, doing a really terrible job of giving people analysis on it because I wanted to build that foundation. I wanted to, because the micro, to your point, is so important. And that's what I learned when I managed default. What's going to work in Florida is not going to work in Texas. And so, you have to understand these local markets. And it seems crazy that someone could actually understand the macro and the micro together, but that's really what I'm trying to do. And so I'm getting close to being able to do a presentation style on my YouTube with like census and sub-census regions, but drilling down to cities. So I really do try to see that distinction. And then when I go boots on the ground, we kidding, but I think I lost you for a second.
Yeah.
Okay.
Oh yeah. It's a pleasure of going live. So
So yeah, like Raleigh, they've been expecting Apple to come since, I think 21, and it looks like they're not going to break ground till 27. And so if you don't know things like that, you can't understand what's actually happening in that market. And so this next trip I'm about to go on to Texas, we're really going to be doing a very new format where we go to existing neighborhoods, new builds, commercial real estate, food banks, interview people there to because that's really what we're trying to do, is like give everybody a true, kind of street level perspective of what's actually, and not in the aggregate, because the aggregate can hide all kinds of gnarly things. Yeah.
Yeah. So do you think some of these personalities like Neil Bawa, who's like really bullish on build to rent, but he's the mad scientist and he's data driven, and he seems to claim that he's got some kind of foolproof plan where he can identify areas to go in and build multifamily for rent? Do you think that's all just kind of marketing and hype to build more products? Or do you think that sophisticated people that do some data analysis can find these markets and still continue to operate?
Yeah, I think that would be the exception, not the rule. If in fact, I mean, you have to, the amount of data that you would really need to understand, and it's not the way we get our data today. If you just tried to use ChatGPT or AI to understand it, you would be lost. You would be completely clueless. And so, no, unfortunately, I don't think, it's likely, from what I understand about his model, that it's going to be all okay. But, could you find good deals? Could you find the right place? Absolutely. Like foreclosure, I tell people all the time, go look at delinquent property taxes if you want to get a good deal. I mean, that's, so, but no, I think everywhere is going to be impacted. There will be a few winners. I think the Midwest actually probably has a better shot than anywhere. Believe it or not, Detroit, places like this, port cities that, are still somewhat affordable. Access to water. I think, there's a lot of things that people just aren't taking into consideration. Like in Phoenix, for instance, you had an entire subdivision that they just had to scrap it, already built, because they didn't have the groundwater. So I just have not seen, like you were saying, proper due diligence. And so it is unlikely to me that somebody's got the magic number out there. And we see Blackstone. I mean, who are they kidding? Like right now, what they're doing is shuffling things around to other partners so they don't have to take the write downs, but they are in for some serious trouble. It just takes time.
Yeah.
So Melody, in terms of the work you do for your clients, what problems are they having that, how is it usually segue from like a contact or a consultation, and then what type of problems are they having, and then what does your scope look like from there?
It's a crazy scope, kind of going back to what you called out about the chaos and things. Like I kind of thrive in times like that, even though it takes a toll, of course. And so my scope is very wide. And so, for instance, I do something called subservicer oversight, where just because there's not a lot of people out there that have the servicing expertise like myself, and origination, they don't understand how the two go together. So I do subservicer oversight, just making sure that the servicers are handling the lender's loans okay, that they've decided to retain. But then on the I'm building a technology to rival said technology that we were discussing, where it's a true short-term rental calculator, and it's not going to take a 10-mile comp radius. It's it's going to be way more sophisticated. That's a client came to me with that problem, and I'm helping them solve. So and then I like a lot of strategy around asset sales and things like that. And so I haven't done a lot of consulting yet for like people that just contact me, like from my YouTube channel and things like that, just because I'm going to be cautious about getting into, consulting investors and things like that directly. But yeah, really, it's a lot of like, okay, why are my escrow advances Like, why did I lose $60,000 last month? What's going on? So just a lot of different, a wide range of projects that I have with my clients.
Very cool.
All right. So you said YouTube. Why did you start a YouTube channel?
Because everybody told me to. I mean, I know that sounds crazy.
It sounds antithesis to the stuff we're talking about, STR and MTR crazes. So
yeah, it's like people kept telling me, they wanted to hear more. Like they saw me on different shows, or they heard me on Twitter Spaces, and they're like, you just need to get out there, no matter how crappy it is, because you just have a certain like niche of knowledge that nobody, hardly anybody has the mortgage finance plus the origination plus the servicing. And then the GFC experience, of course. And then I earlier in my life worked for a senator. So the politics, all of that stuff, I just kind of have, and then the academic research. And so everybody just kind of told me you need to, and I couldn't believe it. I mean, I think when I did Adam Taggart's show, I probably had about 700 viewers at the time, which I thought was crazy. Like, why would 700 people want to watch me? And then I just crossed 12,000. I don't have any idea what I'm doing, and I'm terrible at it. But I
you're
think
very good at it.
Oh, thank you. But I just think that people need to hear this, and they need to, like, the narrative that we're hearing out there is just not what's really happening. And I'm just interested in providing facts. Like, if suddenly we all get, there's a breakthrough with AI, that means everybody's going to get this great high paying job and can afford these homes at these prices. I'm going to be jumping up and down. I just don't see that right now. But the minute I do, I'll tell my viewers,
Yeah. So how do you think current monetary policies, like the interest rate adjustments by the Fed, are impacting both commercial and residential real estate markets? And then what strategies should investors consider to mitigate the potential risks?
Yeah, I think right now the Fed is just trying to drive narrative. And, you can see, right, the bond market today and what's been happening the last couple of days with the 10-year at, pushing over 4 or 5, like, this is the Fed can go out and talk all it wants to, but I think that in reality, the bond markets truly do lead rates. And so I think the Fed is just kind of, and this is probably a take that not a lot of people have, but it's one I came to after studying monetary policy, Eurodollar University, the way the global liquidity system works. And I think a lot of times they're just they don't have enough control or power anymore. They need the banks more than the banks need them, honestly. They need the banks to continue buying MBS. They need the bank. And so, I feel like what we're all being subjected to is just this grand performance that no one else can, everybody's talking about. And that's the only thing that matters. When in reality, this is about supply and demand is constrained because of affordability, and supply is being misrepresented, in my opinion. When I saw the builders start taking listings off realtor.com in December, which is what Fred uses, or the Fed, for inventory, but I would go and see it on Zillow. Fred doesn't use Zillow. I knew like something was happening. So it wasn't anymore just that they put one card online and they had 70, spec homes there. It was, they literally took them off of realtor.com and, kept them on their site, kept them on Zillow. Now, what's a couple $100 to a national builder to keep that listing on Realtor? Why not put it everywhere? This wasn't about saving money. And so I think that everybody needs us to keep leaving in that inventory shortage. So that, the narrative persists until we get through the election. And I think that's when we'll start to really see the pain. But in terms of, is it going to save commercial real estate if they cut rates? No. 75 basis point. I mean, the way that commercial real estate gets saved is if they can suddenly go, refinance at 0%. I mean, that is how they would get saved. And that's just not the reality, because you also have, credit tightening, and you have people way more cautious now. Most folks, except for private credit, who just kind of went crazy. Most folks have been like, okay, now it's time to kind of slow down and really pay more attention to our underwriting. Private credit's its own, animal.
Its own animal.
Yeah. One to pop in here is a lot of people don't really understand like this sort of like, supply and demand. A lot of people say like, oh my gosh, like I can't find a house or something like that. And therefore demand is through the roof, for instance. In Rochester, New York, for instance, we have a ton of inventory, okay? Vacant inventory. The problem is that we don't have incomes that are commensurate to actually absorb that inventory. So we have this sort of almost like tale of two cities, where we have people that are unhoused or doubled up and tripled up, and there's inventory that's out there that is that basically they can't afford to rent or buy.
That's right.
I think it's really important that people understand that that element to what we're seeing out there, because we are in a low demand market in Rochester, but in certain areas though, it's like there's no inventory in certain areas because they're they're very highly desirable areas. There's incomes that are high enough, like commensurate to that, to actually absorb that inventory, but there's this entire other amount of vacancies that are out there that just that are not being met.
Right. And I just read a recent article, like you take, for instance, New York City. There was an article today, rents in New York dropping, shocking, because their vacancy seems so low. Well, that's because like 300,000 apartments are being held off market because of that, 2019 change in legislation around raising rent and affordable housing and rent control. And so, I mean, I think too, that people are just it is just, again, I'll say it's shocking how much vacancy is out there. And there's a whole bunch of reasons for that I think is just not commonplace knowledge. But to your point, absolutely, people are like, oh, in Montclair, New Jersey, you can't, there's multiple offers, there's this, that, and the other. But yeah, okay. But let's go to Pittsburgh. Let's go to Philadelphia. Let's talk about some other cities. To some extent, there always is going to be some local, issues at play, but something like what I just mentioned in New York, you need to know that, because what if those 300,000 apartments come on tomorrow? What's that going to do to your return on investment? And right now we're seeing, with even that, low vacancy, we're seeing rents decrease in New York.
Mm-hmm. Yeah. So, Mark, can we talk more about because so Mark and I are like, we're like content geeks and that sort of thing. It's like, how can we give more value to people out there and audiences and that sort of thing? So it's miraculous that we're able to build up to 12,000 subscribers on YouTube. And a lot of people see YouTube as like entertainment, or if it is educational, I have to put some sort of like salacious, like clickbaity type of stuff out there. And so there's a lot of people that have the technical expertise that you do and the lived experience through your professional life. Kind of like because I want to use this as like some sort of encouragement for people that, have a lot to give out there, that maybe like, hey, I'm not like a influencer and that sort of thing. Like, what's kind of like, how have you been able to like build so much interest, and like kind of like what's your secret sauce? I'm selfishly curious.
I can't say for sure, right? But I think that the fact that I don't do that, I don't put, the wide-eyed, everything's crashing, shocking news. Like, I think that I don't even say like and subscribe. I don't, I just say, here's how you can reach me, and I tell you good news and bad news. I try. Listen, I can't be totally objective. I mean, we're human, right? But I try really hard to give both sides of the argument, and I try not to get too overexcited about it, and I'm passionate. I do think too, like the knowledge, like just bizarre knowledge that I've gathered, it's a unique perspective. So I think it's that combo. And then also, God, I don't know. I think that this is, I feel like I've found my purpose, and it's educating people in this moment in time and helping them really navigate this and probably what's coming next, unfortunately.
Yeah. Maybe talk a little bit about what you think's coming next, because I would love to know. I probably share your belief too. It's like we've been kicking this can for so long. Everybody thinks we can just keep kicking it.
Yeah. I mean, listen, there's always a chance of an exogenous event. The UFOs, a war where we're all going to the factories making bullets again. I mean, who knows? There's all kinds of things that could happen. But when you look at the dynamics at play, we pulled forward so much demand. And now we've, you look at FHA, which is, doubled since 2009, credit scores, 580, 620. We've put people in homes that can't afford it. They didn't realize, oh my gosh, your assessed value, because you're a new homeowner, you don't get, that those caps that you get like in California. Because you're a new homeowner. And so I saw people just get hit with crazy supplemental tax bills that just sent them right into, delinquency. Boom. Overnight, they got a notice in the taxes on the property. When that originator gave it to them, they said, oh, the taxes were $2,000 last year. They got a bill. They're $30,000 this year. And that new homeowner is like, what are you talking about? And I'm sure the originator had said, well, they could go up, they'll get assessed in the middle of the year. So, I just think that we have, in many ways, we've just replayed, and this will get a lot of hate and I'll be called a doomer or whatever. But this is very similar to what happened in the GFC. It was those non-traditional products, not subprime. It was a lot of and the Fed has done some great papers on this. And those non-traditional products that really, I mean, I can tell you, my institution, we didn't do low credit quality, not really. We never went below 600. I'm seeing credit scores right now I've never seen in my life. Just like, whoa. And they're not in foreclosure, in the 400s, so just crazy. And they were at 750 when they were originated. Wild stuff. So I just think that we are in for a lot of pain. We've done a lot of, in some ways, the COVID forbearance, which the forbearance was 18 months, but you got to tack it all at the back of the loan. That was an equity withdrawal similar to what happened during the run up to the GFC. It's just nobody looks at it that way. And many people don't even look at those balances. They're truly second liens, but people don't even know they exist. And so that's a lot of and also you had quickly, FHA, Fannie, Freddie selling a lot of their non-performing loans to investors and not letting them foreclose for 2 years, 5 years. So we've just got a lot of stuff that has been hidden. I like a schedule I just saw from Inside Mortgage Finance, on credit risk. We exclude everything with a credit score below 600. Wait, what? I mean, I just think everybody has been hiding things. They've been kicking the can. And so unfortunately, I think this cycle and what we're about to experience is going to be it's going to be more painful than, in my opinion, than the GFC. And it's probably going to be longer, so.
What's going to happen to older people that are on fixed income when all of a sudden, their taxes have gone up way more than they thought they would? They did the right thing. They paid for their house over the course of their life. Now they're entering retirement on this fixed income, and their taxes and their insurance are starting to go through the roof. Is there going to be any kind of relief for them, or are they just kind of stuck?
Well, I think there will have to be. I mean, right now we're seeing the biggest increases in our homeless population are for the 55 plus. I know people in my own family that work their whole lives and can't afford, their rent. And a Wall Street Journal article from yesterday, exact, veteran, but also had worked on $2,000 a month. He couldn't even afford his property taxes, So I do think, though, the nature of the game is that somehow there will be relief provided. You can't, and this is, a contentious subject, but you can't give subsidies or a debit card to immigrants and not take care of your seniors who are also suffering out there and homeless or living in a van. So I think there will be some policy response. I do believe that we have, affordable housing is going to be a top 3 issue in this election. You can feel it already. And so there's going to be all kinds of bad responses, probably. I mean, but it's almost as if we have lost our ability to provide solutions. Like everything is just something else that kind of increases. The more government gets involved, the more expensive everything is. And so, but they're not going to let these seniors go homeless. I mean, that they just won't. They'll lose their office if they do, because they're the biggest, group out there.
Mm-hmm. Yeah, the more expensive. I mean, the affordable housing in New York State, eye-popping numbers in affordable LIHTC housing. I think the latest project that they just had a ribbon cutting for. No, it was a shovel. One of those like shovel ceremonies, right? Was $560,000 a unit for a rehab in a old 1970s public housing project for rehabilitation for something that was built during the urban renewal era in the United States. I'm like, why don't, for that price, okay, and this is like for studio 1-bedroom apartments, right? And obviously the tail that wags the dog is that the developers don't get paid any cash flows out of the property. They get paid these fat developer fees. So they get incentivized to make, to basically, okay, the more expensive the project, the better. And so, which also delays the delivery of affordable housing units that are like, let's say that are for people that, need affordable housing the most. And I'm like, we could build out tract subdivisions and build out houses that like an actual houses for like $250,000 a piece,
right,
and give the keys to these people.
Right.
Exactly. And so, but nobody's talking about it from that perspective. Another
That's
idea
right.
that we brought to the table, because I was in the housing quality task force, is all right. One of the things is that there was a lot of people that were in the naturally occurring affordable housing space, housing providers, that left because of the eviction moratoriums and the Housing Stability and Tenant Protection Act of 2019 that made the provision of naturally occurring affordable housing as a business untenable. So we had people that dumped their properties, got out of the business altogether, got into STRs and MTRs and self-storage and all that stuff. I'm like, why don't we do this? If we can eliminate the risk for them, for the payment risk to deliver high quality affordable housing, why don't we have them do 10-year master leases? If they deliver the product to whatever specifications we want to from a public policy perspective, they master lease for 10 years. And then basically they just get a fixed income payment on there. I surveyed like hundreds of landlords if they'd be in for that. It's like, you mean I get guaranteed payment over 10 years if I just like do my job? I'm like, yes. Would you be in for that? And I brought this policy solution, and it wouldn't even like require like the, taxpayer dollars for something like that. It would just be guarantees. And the policymakers looked at me like I had 10 heads, like, no, it's like, no, we just need more of the same of like $600,000 a unit for these affordable housing projects. So I'm just like, yeah, I agree with you. I think that, why aren't we focused on like actual solutions, actually meeting the people that have ideas and meeting them where they are, not waiting for them to basically be like, what the hell is going on with this like crazy nonsensical bull crap that's out there.
Right. It's like tiny homes. We don't need tiny homes. We have plenty of vacant homes, like I promise you. And, like a project down in Atlanta called The Melody, where they took shipping containers. And I think they were somewhere around 500,000 a shipping container to rehab. I'm just like, it's wild. But, if everybody's getting paid, and if their paycheck depends on it, they're not going to see the solution, especially if it's going to be disruptive to them. But I think that there's a lot of people not getting paid. You're hearing a lot about, construction crews not getting paid. You're hearing, invoices. So we're just in that moment, in the inflection where the liquidity is being sucked out. And so, a lot of things that made sense before are just going to stop making sense. And I do believe that once the election is over, there's going to be a showdown over our deficit spending. I mean, I really do believe that.
Yeah.
All right, we're at the top. We're at the top of the hour. Want to close it out, Mark?
Yeah, or Melody, if you want to give a positive spin on stuff, since we are kind of ended on a negative note, that's fine too.
Yeah, I don't really, I mean, positive, I think, the best thing you can do is just educate yourself, arm yourself, understand that the people out there pumping the headlines, and trying to create that FOMO, they're not acting in your best interest. And so that's just a message I would want everyone, and try to just dig a little bit. I know we don't have a lot of time, just living takes up all the time. But if you can just dig a little bit, stop by your show, stop by my show, we're digging into the issues. I think that's in your best interest, especially if you need to sell or buy a property in the near future.
Awesome. Well, thank you so much for coming on. This was great. I really enjoyed it. I'm sure Matt did too. And hopefully we can have you on again in the future.
Absolutely. And thank you so much for having me.
Yeah. Thanks, Melody.
Thank you.
We'll see everybody next week
On the Misfits of Real Estate. Bye-bye.